We're happy to have Ilya Strebulaev, a chaired professor of finance at the Graduate School of Business at Stanford, here with us. Ilya is also a research associate at the National Bureau of Economic Research. He is an expert on venture capital and innovation and teaches one of the most popular courses at Stanford on venture capital and angel investing. He's also doing research on venture capital and entrepreneurial finance and is currently in the process of writing a book based on his research. Ilya has been awarded the MBA Distinguished Teaching Award and the Sloan Teaching Excellence Award at Stanford Graduate School of Business, as well as the inaugural Masters in Management Best Teacher Award at the London Business School. His work includes papers published in the major academic journals, and he has numerous awards for his research paper. Ilya, welcome.
Hello, everybody. I know that I am the last person standing between you and all the great fun afterwards. So I'll try to be quick, but also will be fun. Now, I'm a professor of finance, so I will talk about finance. And I will talk about money and about valuation. And a very simple question I'm going to ask is, what is the value of all those high-tech, wonderful companies that are backed by venture capitalists? These days, people talk a lot about the valuation in the high-tech market. And when we think about whom to ask these days in the United States, the first person, about any question, the first person we turn to is Donald Trump. So let's see what Donald Trump has to say about high-tech investment valuation. Recently, in a Reuters interview, he said, you have a stock market that is very strange. You look at some of these tech stocks that are so weak as a concept and a company, and yet they're selling for so much money. So Donald Trump definitely thinks that all those highly valued VC-backed companies are overvalued, valued too much. So is he alone in professing this opinion? Well, here is another person who is a very reputable and very influential chair of the United States Securities and Exchange Commission, Mary Jo White. Recently, she spoke at Stanford. And she said about unicorns. Now, when she talked about unicorns, she did not mean those legendary mythical creatures with pointed spiraling horn that are so rare that nobody has ever seen them. She meant, of course, highly valued VC-backed companies. And she said that maybe those companies appear more valuable than they actually are. Now, those are Trump and Mary Jo White. The question is, what do investors that invest in these unicorns actually think? Until recently, we do not know. We have just finished conducting the survey of venture capitalists with about 1,000 venture capitalists, and specifically we asked them about the unicorns. And we're living in the era of the unicorns. So I'm going to define unicorn as a private VC-backed company with a valuation of $1 billion. And let me provide you brief statistics of the unicorns. There's 436 unicorns globally, 242 in the United States, the rest in China and Europe and in other countries. 166 became unicorns just recently, so a vast number of them became unicorns very recently. And 1.6 trillion if I add all the valuation. Just to provide you some numbers for the US audience, this is the GDP of the state of Texas. And for the international audience, this is just shy of the 2014 GDP of the Russian Federation. So, what are these unicorns? We all know about Uber and Airbnb, but there are many unicorns about whom many people have never heard. Again, there are hundreds and hundreds and hundreds of them. So what do investors think about their valuations? Do they think that they are overvalued, fairly valued, or undervalued? So again, we do not know until recently. With my colleagues, Paul Gompers of HBS, Will Gornell of UBC, and Steve Kaplan from the University of Chicago, we surveyed about more than 1,000 venture capitalists. And those of you who are venture capitalists in the audience, thank you for participating in the survey. This is the very first survey of its kind. We asked a lot of many questions. If you're interested, the full survey results will be published soon. But one question we asked in particular was about the value of unicorns. 92% of those VCs said that unicorns are overvalued. 9 out of 10. So if you believe, if you happen to be VC, who think that unicorns are fairly valued, you are in underwhelming minority. Not only that, 75% believe that unicorns are very significantly overvalued. And independently of how you slice and dice this 1,000 venture capitalists, whether those who invested in unicorns, if you invest in unicorns, you still believe that they are overvalued. Whether you're IT, whether you're top venture capitalists, whether you're California venture capitalists, whether you're late-stage venture capitalists. So investors believe that unicorns are significantly overvalued. Okay? Let me provide you one example of this unicorn. You may have heard about this company, WeWork. It's a shared office space, and on March the 1st, 2016, the company raised $430 million that valued the company at $16 billion. That is what Wall Street Journal article said the next day. That would make WeWork the third most valuable publicly traded office landlord, were it publicly traded, even though it controls only a small fraction of the square footage of the leading companies in the sector. So if you think a little bit about this, it kind of does make sense. There's a company that just recently started that is an office space company that controls a very small fraction of the space of the other leaders, and yet it is the third most valued company. So what is happening here? And this is what I'm going to talk about today. Before that, let me tell you what is actually valuation. So most of us know about public company valuation. Here is data from Tesla yesterday evening. If you were trading like me after hours, the Tesla was trading at 219.58 per share, and the number of shares about $146 million. So that is the value of Tesla. The value of Tesla equity is we take the share price, we multiply it by the number of shares, we get $32 billion approximately of the market capitalization, as we say, of Tesla equity. So that is all very straightforward. What the Wall Street Journal cheerfully did is that it compared WeWork with the way Tesla works, so with the way Tesla is valued. Okay? Is it? Actually, the answer is no. So the question is, does $16 billion WeWork valuation is the same as the market capitalization were it publicly traded? The answer is, and the answer that dramatically affects all the founders and employees sitting in this room who are funded by venture capitalists, the answer is resounding no. Why? Because the valuation that we use in venture capital contracts, in the venture capital industry, is not market capitalization. It is called the post-money valuation. Post-money because it takes into account the money raised in the latest round of funding. Again, the public company valuation is you take the market cap, so to arrive at the market cap, you take the price of one share, you multiply it by the number of shares. But all the shares are the same. All Tesla shares are common shares. In the private venture capital-backed companies, this is not the formula that is used. What is used in private venture capital-backed companies is the post-money valuation, where we take the price of a preferred share that is issued, that is given to venture capitalists, to investors in the latest round, and then it's multiplied by the total number of common shares. So we take preferred shares that only some investors get, and founders and employees typically do not get at all. We multiply by the number of common shares. The point is that preferred shares are very different from common shares. And therefore, we cannot compare at all the valuation, the market capitalization of any publicly traded company with the post-money valuation. And that is what the Wall Street Journal and so many other people, including people in this room, I'm sure, are doing every single day. Here is the stuff I teach my MBA students. I'm going to condense 1/4 of intense venture capital course into one slide. I have here company's exit multiple. So I care about, you invested money or your founder, you care about your exit multiple. And the red here is what the founders get. The founders and the employees typically have either common shares or options on common shares. And the blue there are the venture capital investors. They get preferred shares. And the name preferred has a meaning. It's preferred because the shares get preferential treatment. If the exit, you see it on the left, if the company is not that successful, if the exit is relatively low, the founders get nothing or zero. But venture capitalist preferred shareholders' return is preferred, preferential, they are paid first. What happens if the exit is great? If the multiple is high, well, here in my example I have participating share. Participating preferred share that is very frequently used. Participating has a meaning. You can participate, if you're a venture capitalist, on equal with the common shareholders. So as you see, whatever the exit multiple, preferred shares get always more than common shares. One preferred share is always more valuable than one common share. That is the simple takeaway from one quarter course of venture capital at Stanford. Okay? So one preferred share, okay, this wonderful king's crown, is more valuable than a common share or a stock option. So what is the classical approach? Here's my example. Let's say we have a unicorn incorporated, just sold preferred shares for $10. And therefore, the post-money valuation that is used in WeWork and everywhere else will assume that each share of the company is worth $10. So let's say we have 3 common shares and 2 preferred shares. By the way, note that I have 2 different classes of preferred shares. We can have round A and round B. So we can have many, many preferred shares, but all of them are more valuable than a common share. What is going to be assumed that each share, each common share and different preferred shares, each going to be valued at the price of the preferred share just issued. So what is going to be the post-money valuation? $50. So whatever the fair valuation of the company, and if you're the founder or the employee of a unicorn or any VC-backed company, you kind of might want to know what your paper money is worth. Whatever it is less than the post-money value. That is implied by post-money value. The question is by how much? And until recently, we just did not know. And here is where finance theory comes to rescue. And this is what really we're coming to the meat of what I'm going to talk about. With my former student and now my colleague and co-author, Will Gornall, we developed a financial model that is sophisticated yet practical and beautiful, that allows to value each common or preferred share of any VC-backed company. So basically, for every single VC-backed company, unicorn or not, our model can tell you what is the fair value if this company were actually traded in the public space. What is the fair value of each share? You can ask what kind of information we use. Well, the information we need is only the price of the latest round, and we need the contractual terms for all the shares. So basically, we don't need to know who gets what for every single exit multiple outcome. So if you're a founder of the company and you would like to know your fair value, so send me your data confidentially, and our model will tell you what your fair value is. Okay? So let me tell you, going back to my simple example of unicorn, okay, we don't use this valuation, post-money value. We use our model, GS model, to price all the other shares. Okay? And so if in our case, the price is going to be substantially smaller. So this is, of course, just a simple example. But in this case, the fair value of the company is going to be half of what the post-money value is. Preferred shares are much more valuable than common shares, but some preferred shares are even more valuable than other preferred shares. So common share is 1 vote, typically, plus 1 share of the exit. Preferred share, 1 vote plus 1 share of the exit plus a guaranteed payback, guarantee of their money back. But some preferred shares are even more preferred. They can have some additional liquidation preferences. They can have participation. They can have anti-dilution provisions. They can have IPO price guarantees. They can have cumulative dividends and a lot of other features. So our model is going to take into account every single contractual feature imaginable that will be important when exits happen. And one thing that I would like you to remember, unless you are the founder of Unicorn, if you're a founder of a startup, that multiples of 10x plus that all of us dream about happen relatively infrequently. Much more frequently happen 1, 3x. And these are, to some extent, very successful outcomes too, okay? Well, for these exits, it turns out that contractual terms matter greatly. If you are valued at $100 billion, contractual terms are relatively unimportant, the one that I showed you. But contractual terms matter greatly, and so your value as the founder can change dramatically with the one simple twist in the contractual term that you might not be aware. That you said, well, let my lawyers deal with this, or let my venture capitalists deal with this. Well, your value could be just halved if one contractual term changed. Let me give you just one quick example. Here we have the traditional convertible preferred equity that most venture capitalists use these days. This is the participating 2x preferred equity that is less frequent these days, even though in my data of 7,000 plus venture capital-backed companies, we have a lot of companies like that. But if you look back in 2008, 2009, 2010, where the funding market was difficult, those were prevalent. So we may still be there. So you see what is the difference between how much money venture capitalists get on the left and on the right. And of course, that is critical for the fair value of the common shares, because the more one party gets, the less the other party gets. Okay? So the post-money valuation is a function of the contractual terms. Here is an example that is particularly interesting. So what happens if we go back to my example of Unicorn Incorporated, but now we promise this venture capitalist, that's one, that we just sold a share of $10, we promised it that better share, a participating share with 2x liquidation multiple. Well, that share is going to be more valuable, okay? And therefore, that share will be worth $20. You see, it's much bigger, okay? It's more valuable, so you will sell it for bigger, okay? Well, the post-money suddenly is going to be $100 now. We still have 5 shares. We're going to value it at the price of the recent round. The post-money valuation goes up from 50 to 100. Yet, you got your venture capitalists, you got these preferred shares, better treatment at the expense of common shares. Post-money valuation went up, even though the return to common shareholders potentially decreased. So higher post-money valuation does not mean at all that common shareholders, founders, or employees getting a better deal. Let me give a specific example of one company. I told you we have 7,000. Of one company, I'm sure you all know it, space exploration, known as Spacex. It's a great company for me because it's been in existence for many years, so I have a lot of data. It raised money again and again, okay? And let's see what happened. So this is going to be years. The blue is going to be the post-money valuation reported by the Wall Street Journal, by all these data sets. And red is going to be the output of our model. For the math wizards in this audience, this is going to be the log scale over there, because the change in valuation is dramatic, okay? So the company started in 2005, was successful, raised money in 2007. Notice that the value is lower than, the red is lower than the blue line. It's always going to be the case, okay, always. And you think that it's a very small difference? Well, it's log scale. Actually, the difference is quite large. Wow, what's happening here? This is the financial crisis. This is the month or the year where NASDAQ decreased by 40%. And yet, if you look at the post-money valuation of SpaceX that raised money exactly in that month where everybody was collapsing around, its post-money value went up. And let me tell you, I'm a great believer in electric cars. I'm a great believer in privatized space exploration. Okay? I can't believe as a professor of finance that in the month where the NASDAQ was down by 40%, the company that is extremely speculative went up in fair value. Well, that is not a fair value. That is our model's result, that you showed that the fair value of this company was substantially lower than actually several years previously when it raised money for the first time. How could this have happened? Because the investors that invested in this round got a very special liquidation preferences. They were guaranteed 2x of their money. That increased the post-money, or their price, the post-money valuation, the seemingly everybody price, but actually the fair value went up. So then the company, the SpaceX, of course, is doing quite well, okay? It went out of crisis. Here, Series E investors participate and are senior. So again, they have preferential treatment. This difference is actually quite huge again between the blue and the red square. And then we have more rounds. And the latest round I'm going to show you last year, Series G investors, this is the latest round, can get their money back at any time. What a wonderful investment, okay? And you see this explains, again, the big difference, okay? So we can do this for every single company, and we can evaluate the fair value. This is the value of the company. Of course, we can do it for every single share class of SpaceX or any other company, okay? Now, why that is important? I titled my talk, Do You Believe in Unicorns? SEC chairwoman said that maybe these companies inflate their valuations. Is there evidence of that? So this from another piece by Will, Gordnall, and me. So this is the companies that raised at the post-money valuation, okay, in the past year or two, and this is the in $1 billion. So as you see, suddenly there are so many companies that would love to be unicorns, okay? And maybe they time the market well, or maybe they twist their contractual features. Again, it is not that difficult. So it seems to be that there is a unicorn effect, and the SEC chairperson might have been correct. So what is the outcome of our model for the class of unicorns, and actually for all other VC-backed startups? It is difficult to generalize because, again, every single term is sometimes complicated and intricate. But post-money valuations are, on average, between 30 to 200% higher than fair values. Just to make sure it sinks, okay, it means that a fair value of a company is between 1/3 and 70% approximately of post-money valuation. And more than half of unicorns have post-money valuations of less than $1.6 billion. And almost all of these unicorns actually have fair values below $1 billion. So if you think about fair value, then 100+ unicorns in our sample is culled from the herd, okay? So this is the true state of the unicorns. And just to make sure, I'm not saying that these companies are not doing something right. Many of them, maybe most of them, are great companies. But post-money valuation is not the true statement of how valuable actually they are. If you would like to understand what your value is, if you're the founder, the employee, or the investor indeed, you need to think about how to apply our type of model rather than to think about post-money valuations, okay? How many unicorns have been out there? Well, we're kind of at is there the extinction of unicorns? This is the number of new unicorns in the United States in 2014, 2015, and this year has not been that great for unicorns, okay? Unless you look into our friends in China, okay? So China is on the rise, so maybe I should learn Chinese and give this talk in China, okay? There's a lot of Chinese unicorns these days, and of course, the fair value model that we developed applies both to US, Chinese, or indeed any other VC-backed company in the world. Am I saying that the VC industry is doing something wrong? Absolutely not. So in fact, we did another piece of research about the economic impact of venture capital, where we found out that if you look at all the companies that went public in the United States in the last 40 years, every single one, more than 40% of these companies were funded by venture capitalists. That's remarkable. Basically, the venture capital industry is the growth engine of the United States economy. Out of every single dollar that these companies spend on research and development, 82 cents are spent by venture capital-backed companies. That's a big statement. So I'm not saying that the VC industry is unsuccessful. It is definitely successful and definitely brings a lot of social good. I'm talking about, of course, the distribution of wealth, the distribution of value between different investors, between founders and employees. So if you're interested in what I've been saying, there's research to look out for more about the venture capital survey, about the economic impact, about the valuation of unicorns and other venture capital-backed companies. And I will be very happy to answer any questions after my talk. Thanks so much.